I'm Matt Bishar with REIT.com here in New York City for REIT Week 2014. Joining me today is Kevin Shields, the Chairman and CEO of Griffin Capital. Kevin, thanks so much for joining us today.
Pleasure. Thanks for having me.
I'd like to start by talking about the public non-listed REIT space, a sector that you're obviously very familiar with. How have you seen it evolve over the years, and what are some of the developments that have helped broaden its investment appeal?
I'd probably say the level of transparency has increased dramatically over the last half a dozen years. I sit on the board of the IPA, the Investment Program Association. The IPA is to the direct participation space as NAREIT is to the publicly traded space. And we have gone to great lengths to increase the level of transparency in the space, to which we release best practices as it related to modified funds from operations and how that's calculated and that information disseminated, especially relative to the dividend distribution. Last year we came up with some best practices relating to NAV and how that should be calculated and ultimately disseminated. That has all certainly helped, I think, in the appeal of this product, just to allow the financial advisors and the clients to better understand and get a better glimpse into what's going on at the portfolio level. And then there's been a lot of pressure on fees and the fee component, which has all been positive for the industry. The eradication of the internalization fee, for instance, compression with respect to some of the acquisition fees and ongoing asset management and property management fees, all of which I think has helped the performance of this product.
So in addition to the public non-listed offerings that the company sponsors, are there any plans to add additional companies, and in what sectors are you seeing some of the best opportunities right now?
So as an advisor, on the advisory side of our business, we sponsor the Griffin American Healthcare REIT 2. We're in the market right now with Griffin American Healthcare REIT 3, which is going to be largely a repeat buying medical office, skilled, assisted, and hospitals. Griffin Capital Essential Asset REIT is our non-traded net lease platform. We're in registration right now for Griffin Capital Essential Asset REIT 2. So that focuses on buying long-term single-tenant net lease office and industrial assets. We have filed an interval fund, which is a fund-to-funds vehicle, which should go effective this month. Similarly, we're looking at the BDC space. We're looking at a hospitality sleeve. Anything that kind of fits the shape of the economy going forward. If you have an expectation or an anticipation of increasing interest rates or increasing inflationary environment, not a bad idea to think about shortening the lease duration, and hospitality is a good product example of that.
And lastly, Griffin Capital Essential Asset REIT targets properties that are essential to a company continuing to operate, like a headquarters, key distribution hub. Does that focus make it more difficult to find and acquire desired assets, and have you found the leases on these properties to be more stable?
Be more stable because we're buying long-term single-tenant assets, and to which the tenant has made a meaningful economic commitment to the space, which is kind of how we get around this essential or contemplate the essential nature of the assets. So we're really focusing on buying assets that are critical to the ongoing business operations of the tenant and properties in which the tenant has made a meaningful economic commitment. So I think it creates not only stability with respect to the lease equation in the first instance, but also the probability of us achieving a lease renewal at the end of the day, and some rental rate growth at the end of the day. There are, hundreds of billions of dollars worth of corporate-owned real estate out there. So finding product has not been that difficult. We really want the corporate finance department of a corporate entity to view us as an extension of their corporate finance department, if you will. So we're really one more arrow in the quiver of a corporate finance execution. So it hasn't been difficult finding product. It's obviously getting more competitive out there from a pricing perspective. So I would appreciate if everybody start backing away a little bit so the cap rates could decompress and we could be a little bit more robust with respect to our acquisition pipeline.
Kevin, thanks so much for joining us today.
Yeah, my pleasure. Thank you.
For more on this and other REIT-related news, be sure to visit REIT.com.